Welcome to this introduction to Chapter 3 in the book Macroeconomics. I'm the author of the book, and this presentation is meant as a brief introduction and summary of Chapter 3, which is about interest rates and investment. So in Chapter 2, we considered the supply side, the production function, and the production factors. And we found that with a given capital stock, and when unemployment is on the natural level, and we have a given technology, then that gives us a long run or natural level of production. So that's the supply side. But what about demand? What do we do with the goods and services that we produce? Well, they are used for consumption and investment. This consumption and investment can be private consumption and investment by firms. It can also be public investment and consumption. That is, the government carries out consumption and investment. In the open economy, we also have exports. For the time being, we disregard trade, and we also don't have a public sector. So we use the goods for consumption and investment. So we have supply, the natural level of production, and we have demand, consumption, and investment. So what brings equality between supply and demand? What is the price? Normally in microeconomics you think there is supply and demand, and then there's a price that brings equality between supply and demand. Well, on the macroeconomic level, what is the price? It is the real interest rate. So, what is the real interest rate? Well, it is an intertemporal price. It is the price of goods today in terms of goods next year, or more precisely, 1 plus the real interest rate is the price of goods today in terms of goods next year. So consumers make a choice. Do I consume today, or do I save the money and consume next year? If you spend today, you miss the interest you would have earned if you had saved. Similarly, firms, they choose whether to invest today so as to increase production next year. And they have to borrow and pay interest on the loans to finance these investments. So again, the interest is a cost for buying the goods today to make the investment so as to produce tomorrow. And the real interest rate determines how costly it is to spend today instead of tomorrow. So it affects demand for goods today. And therefore it's very important that the real interest rate is on the right level, because otherwise there will be less demand than the natural level of production, and production will be low, or there will be an overheated economy. So in this sense, the real interest rate is the most important price in macroeconomics. And in this chapter, we will first talk about interest rates. We will talk about the nominal interest rate, the discount factor, and the real interest rate. And then we will start looking at the demand side. And we start with investment, because we have already been talking so much about the firm's decisions that it's natural to continue with the firm's demand for capital. Why do firms invest? What determines their need for capital? And then we summarize our theory in the form of an investment function that tells us what are the main determinants of investment. So we start with interest rates and discounting. So the interest rate is the price of money. What do we mean by that? Well, let IT be the nominal interest rate for a loan if you borrow money in year t and you pay back in t plus 1. And we write this so that if we have 4% interest, then I is 0.04. So all the time we will write the interest rate in this form. Rather than writing 4 for 4%, we write 0.04. So that's how much more you have to pay back if you borrow money today. If you borrow 100, you will have to pay back 104. So what you have to pay back if you borrow $1 is 1 plus IT next year. And in that sense, this is the price of money today in terms of money next year. Because if I borrow today, I will have to pay back with interest tomorrow. So remember that. The price of money today in terms of money next year is 1 plus the interest rate. But when we're talking about relative price, we can also put it on its head. And we could say, what's the price of money next year in terms of money today? Well, that is the discount factor. 1 over 1 plus I, that is how much money next year is worth in terms of money today. Because if I would set aside this amount today, then I would have €1 tomorrow. And the discount factor is used to evaluate future incomes. For example, if I make an investment and that gives me a return in future years, I can use the discount factor to calculate the equivalent amount to that income stream in terms of money today. So we also need to clarify what is inflation in order to talk about the real interest rate. So inflation is the rate of change of the price level. So inflation today is the change in the price level compared to last year divided by the price level last year. And again, we write it so that if it's 0.03, that means it's 3% inflation. Mathematically, this means that if we look at the ratio of the price next year to the price today, that is equal to 1 plus inflation next year. And that's quite intuitive. So consider a consumer. The consumer has a choice between buying goods today or saving the money and buying goods next year. Let the price of a basket of goods that you buy be P and the nominal interest I. Consider the trade-off. If we consume 1 unit less today, we save PT today. So how much can we consume next year with the money that we saved? Well, you save PT, you put it in the bank, you get interest on it. So then next year you have PT times 1 plus the interest rate. But the question is, how many goods can I buy next year for that? Well, then we divide by the price next year to find out how many goods we can buy next year. So this relative price that we see here, that is how many goods I can buy tomorrow if I abstain from 1 unit of consumption today. So this animal here is the price of goods today in terms of goods next year. And we define that as 1 plus the real interest rate. So the real interest rate is how much more we get next period if we save the money instead of consuming today. And 1 plus the real interest rate shows how much we must reduce consumption next year if we consume 1 more unit now. So for example, if the real interest rate is 10%, that's a very high interest rate, okay? Then if we consume 10 units more this year, we must reduce consumption by 11 units next year to pay back the loan. And often when you talk about the real interest rate, you use an approximation, and you say that the real interest rate is the nominal interest rate minus inflation. And that approximation, it's actually simplest to check it by just taking some numbers and checking that it's a good approximation. Okay, so that was the interest rates. And now we start our analysis of the demand, investment and consumption. And we start with investment. So investments are about 20% of GDP in rich countries, and they are a much higher share in countries that have very high growth rates. And firms have two motives to invest. One is that you may want to increase the capital stock that you use in production. And the second is that, well, the machines that you have and buildings that you have, they actually depreciate over time. They break down or they need to be repairs. So you need to replace the depreciated capital. And that's also a very important reason why firms invest. To increase the capital stock and to replace depreciated capital. Those are the two motives for investment. Now, notation is important to understand. We use capital K with an index T for the capital stock at the beginning of the period. Think of the period as a year. So KT is the capital stock at the beginning of year T, and KT plus 1 is the capital stock at the beginning of the next year. Investment, IT, is the investment during the period, the year T, and delta times KT, that's the depreciation of capital during the period. So a certain fraction, delta, of the capital stock that we had at the beginning of the period is depreciating as we use it for production during the period. And a reasonable number for delta is maybe 7% or so. That's 7% of the capital stock depreciates each year. So we can rewrite the equation we had on the previous slide to say that net investment, that is the change in the capital stock, is investment minus depreciation. And so firms invest in order to increase and maintain the capital stock. So to understand investment, we have to understand the demand for capital. So we assume that the firm has a certain desired capital stock, and then we say, how much do you need to invest in order to achieve that capital stock? Well, that is given by this equation. Investment is the desired capital stock next year, KD T plus 1, minus what you have now, plus the depreciation of the capital stock. And here you see the two motives for investing. You desire to increase the capital stock, and you want to maintain the stock that you already have. So obviously, to understand investment, we have to understand what is the desired capital stock. So we make the following assumptions. We assume that there is a basket of these differentiated goods that different firms produce that is used for consumption, and the same basket of goods is used for investment. So we don't distinguish consumption and investment goods. There's just one basket of goods that is used for both. And so that means that capital can be bought at the same price as consumption, at the price PT. And we assume that the company finances its investment by borrowing money from the household at the interest rate IT. So in this baseline model, we assume that the firms make the investment and they finance it all by borrowing money from the households. When we get to the end of the book, we will talk more about financial markets, the stock market and banks, but now we just say the firms are there, they have a capital stock, and they invest and finance by borrowing from households. And we also assume that firms produce with the stock of capital that they have at the beginning of the year. The investment that you make during the year doesn't become productive until the next year. So this way we have a clean and clear investment problem that we can analyze theoretically. So the firm, as always in economic models, wants to maximize profits. So we ask, what is the effect on profits if we increase capital next period by 1 unit? Well, in order to increase capital next year, we have to invest 1 more unit this year. And the price is PT. So this year the firm has to borrow and invest an amount PT. And that's what's happened in that period. And that doesn't affect profit. All you see is that they went to the bank, or they went to the house, some household, they borrowed some money and they made an investment. Nothing of that affects profits. Next year, what happens? Well, a lot of things happen. First of all, we get an increase in revenue because this additional capital will have a marginal product, MPK. And that will bring us income. But the marginal revenue under monopolistic competition is not just the price, it's the price divided by 1 plus mu. So we have the income is the marginal product times the marginal revenue next year. That's the income you get from using the capital in production. The second thing is we have to repay the loan. And the loan was PT, and we have to repay the loan with interest, 1 plus I. And what is then the remaining market value of the capital stock? Well, we could sell it, the remaining capital stock, at the price PT plus 1 in the goods market. But a share delta has gone away. So the remaining market value is 1 minus delta times the price next period. So these are the effects on profits next period if we borrow and invest this year and produce and then repay the loan and sell the remaining capital next year. And of course the company should increase investment if this is a positive number, this whole sum. So you increase investment until the point where this is 0. So a further increase in the capital stock does not increase profit. So we now consider a symmetric equilibrium. All firms set the same price, and we set this expression to 0 because we know that's the point where you have made the optimal investment or the profit maximizing investment. And then we divide by the price level throughout this equation. And then we get this expression here. And now we know that the marginal revenue is, if we go back to what we did in chapter 2, we know that the marginal revenue is the price divided by 1 plus the markup. And we recognize the expression in the middle here, 1 plus interest times the price divided by the price next period. That is 1 plus the real interest rate. And if we substitute in those expressions into this equation above, we get the condition for the profit maximizing level of investment. The firm should invest to the point where the marginal product of capital divided by 1 plus the markup minus depreciation equals the real interest rate. So this was a bit complicated, but the result is very intuitive. The thing on the left-hand side, that's the real net income from an extra unit of capital. In real terms, you get somewhat less than the marginal product of capital because as a monopolist you have to reduce the price when you sell more, and from that you have to deduct the depreciation, which reduces the return on investment, and that makes up on the left hand side then we have the net real return on investment, and that should be equal to the real interest rate that you pay in the credit market when you borrow to finance the investment. So this is a key equation that you should learn by heart and that we will use a lot to analyze investment and growth and other things. So the equilibrium is illustrated here. If you would have perfect competition, then the desired capital stock would be here. You would invest to the point where the marginal product minus depreciation equals the real interest rate. We have the real interest rate on the vertical axis and the capital stock on the horizontal axis. But a firm that has monopoly power will want to produce less and raise the price, and they also then invest less in capital. So if we use the Cobb-Douglas production function to calculate the marginal product of capital, we can solve for the desired capital stock. And if we consider a long-run equilibrium where employment is on the natural level, then we have an explicit equation here that tells us what the desired capital stock is. But this you can see as the long-run demand for capital, because we are assuming here that employment is on the natural level, which is fine for the long run, but we know that in the short run over the business cycle, employment and production may be above or below the natural level. And therefore the demand for capital in the short run is not quite this. And we will talk a bit about that as a preparation for the analysis of the short run. So in the short run, demand, production, and employment may be higher or lower than their natural level. And the consequence of that is that the demand for capital by the firms depends also on their expectations about aggregate demand in the economy. If they think that consumers will be very pessimistic and not buy so many goods, then they will not invest so much, because there's no point in investing if they can't sell the goods. And that means that over the business cycle, the level of demand in the economy, or the expected level of demand next year, will affect investment. And this effect is called the accelerator effect. So if expected demand increases, firms invest in order to increase production, and of course this will lead to a further increase in demand. So it's kind of self-generating. Expectation about growth leads to investment, which leads to further growth. And this is an important factor of the business cycle. It's analyzed more formally in the book, but now we just summarize what we have learned about investment. So we have learned that investment depends on three key factors. One factor is the expected real interest rate, because that affects the cost of borrowing so as to finance the investment. And we said that at least in the short run, expected future demand matters for investment. And also the capital stock that you already have affects investment, obviously, because if you already have a big capital stock, that reduces the need to invest. So we write down and summarize what we have learned about investment in the form of an investment function. We say that investment depends on these three variables: the expected real interest rate, expected future demand, and how much capital you already have. So how important are these factors? Well, expected growth is really a key factor for investment. Investment is related to growth. You see that clearly if you compare countries. Countries that have high growth rates, they also have high investments relative to GDP. You also see that over the business cycle, these graphs show the percentage change of GDP and of real investment in the UK and the US. And you see that investment is very volatile. It fluctuates up and down a lot, and it's very closely related to the growth of GDP. So when income and demand is increasing, there is a lot of investment. When growth is weak, then investment falls dramatically. So it's really a volatile variable. It's about 3 times more volatile than GDP. And that has to do with the fact that you invest in order to have the machines to satisfy demand. So net investment is closely related to growth. Now, the interest rate, if you look at this theory, it suggests that the real interest rate should be very important, at least if you believe in the Cobb-Douglas production function. The real interest rate has a very strong effect on the desired capital stock. So in the Cobb-Douglas production function, the substitution elasticity between labor and capital is 1, but estimates suggest a lower elasticity of substitution, but still we would think that the real interest rate is important for investment. Finally, of course, it's quite mechanic that if you already have a big capital stock, then the need to invest is smaller. That's kind of obvious. A good example of this is that in some countries you have building booms where you build a lot of houses, and then you come to a point where you have more houses than people demand, and then there's a collapse of investment. And a major factor behind that collapse is that you already have a very big stock. So you see that too when you look at the real world. Okay, so in this chapter we learn that 1 plus the nominal interest rate is the price of money today in terms of money next year. We learn that the discount factor is the price of money next year in terms of money today. And we learn that 1 plus the real interest rate is the price of goods today in terms of goods next year. We also learned that investment has 2 motives: to increase the capital stock and to maintain the capital stock that you already have. And we found a key condition that determines the profit maximizing capital stock. And we summarized the theory in terms of an investment function, saying that investment depends on the real interest rate, expected aggregate demand, and the capital stock you already have. And we learned that investment is a very volatile part of demand in the economy, and it is driven by growth, and expectations about the future play a key role in the determination of investment. So good luck with your studies of this chapter.